Good morning, everybody. We'll wait for another minute as everybody joins. Hi, everybody. Good morning, good evening, wherever you are. Welcome to yet another session of Beyond Bulls and Bears. Bulls are not active, it's bears all there around us currently. Market had a tough week and a tough month. We continue to fall. Nifty was down more than 5% in Feb, ending the month at the lowest point for the month with Nifty next 50 down nearly 10%, sorry, mid cap index down 7-8%. And what is surprising is that the futures OI is up by 20%. We added 60,000 crores in the futures OI this month. I was waiting for the month end data to look at how much of unwinding would have happened in the leverage position, and I'm surprised there is no unwind. And to the extent that what we did is we looked at the FI data and in detail, and what we found is FIs are short roughly 1.5 crore Nifty. Not all of are directional short. Some would be portfolio hit, some would be directional short, and some would be part of the basket. As FIs are pretty long on the stock futures also. So so we did a rough calculation on what is the value of the stock futures OI they would have be long on and what is the value of the index futures they are short on. And we realized that net they are still short by around nearly $3 billion on the futures side. Now that's a pretty long short, as in pretty big short. And with that, they have sold 55,000 crore worth on the secondary market. There has not been much of IPO, so obviously they have not invested that much. But the pace of FI selling has not aggravated, rather it's slowing down a bit. It was lower than the last 3 months average. And what is interesting is that this fall has not come because of the institutions selling, and yet the the OI is going up, which means that this fall is coming without volume. This fall is coming without unwinding of positions. I haven't had a chance yet to look at what has happened to the AUM of the mutual funds, but from whatever I can look at from the DI data, I don't think there is much of redemption there either. So the market is falling, but the market is not getting light. And this fall beyond the point is now not a fundamental fall. The fall between October to December was purely driven by fundamental global parameters. The slowdown, slightly higher valuation, earnings not coming. And hence, we maintained our view that this is a technical correction and we will bounce when the fundamental news flow improves. We have seen that the global has stopped falling, the DXY has stopped going up, the crude is correcting, gold has started correcting. So the parameter for the risk off is slowing down. The bond yields are consolidating by correcting. What it implies is the fundamental macro is improving. The earnings are not that I will say the kind of price and the commentary which is the large caps has given gives me the comfort that beyond the point earnings are not going to see the downgrades which we saw earlier this year in this financial year. That is, which means fundamentals are well in place. Now at 21, 22 times Nifty, large caps don't have much scope to fall fundamentally. But yet, the fact is that the confidence is not there to say that we are near the bottom because the texture of the market continues to be bad and the market is not getting light about it. And that's where I am confused and worried both. I'm worried because what will happen when the actual unwinding will happen? When because the volumes are not there, buyers are not coming. Will that create a panic which is already there, but it's not getting reflected in the position? Smart people who have the appetite and the thought process to put money for the medium to long term, they want to phase it out now because they want the market texture to improve. But how will the market texture improve if there is no unwinding and if the FIs don't turn buyer? Which means ultimately FIs will have to turn buyer or a great news has to come. What kind of great news can come for the capital markets? We are seeing lobbying around lowering of STT, lowering of long-term, short-term capital gain to make it attractive for FIIs. The FIIs ultimately only look at two things. One is earnings and valuation, and the other is the macro. So if the earnings come, the FIIs will come. Yes, the taxes, the currency impacts your net return and they help. But if the earnings are not there, they will not turn by. Unfortunately, the fact is the broader mid and small caps do not have the earnings, the kind of valuation they have, and which is why they are seeing the kind of fall they are seeing. And the worst part is this fall is coming with a drastic fall in the volume both in the cash and the FNO segment. But the OI is not coming now. The increase in the OI of 19% was after on an average of 7 to 8% price correction, which means the OI actually went up by 25% on the value terms. Clearly, the pocket of the market continues to believe. Yes, there's for a buyer, there's a seller. So yes, but what I'm trying to say is that the ones who are losing money are not decreasing their position. After a point, they will have to throw the towel, and when they do so, what will happen? That's my worry, and which is why in the short term, I am not calling for a bottom, but I can assure you one thing: 6 months down the line, 1 year down the line, your returns will be much higher than what you can see now. What will make the bottom? I think for me, probably only earnings can do. But data running into the month end is not good. March is another tough month ahead for us because the NBFCs typically lower their loan book, which means the ones who have taken leverage positions on borrowed money, they will have to bring the leverage down, whether it is FNO or it is cash. Second is most of the people use March to plan their taxes. And hence we could see people booking, because the markets are down, they will use it to book some short-term capital loss and they would like to carry it by lowering their cost for the equity. So net, from whatever I can make out from the experts in the market, March could be another tough month. I worked here very closely with hedge funds, as I've told you guys multiple times, but it doesn't give me the confidence to say where the liquidity is driving because liquidity doesn't have a bottom. And when liquidity hits the market either side, it makes a top which is higher than the fundamental, it makes a bottom which is lower than the fundamental. Fundamentally, mid caps are still above the bottom. So mid caps has for me a lot more pain. Large caps, there will be bouts of selling, or there can be bouts of selling, but broadly, on an absolute term, I don't see much fall in large cap. My technical team says that at 21,800, there's a good support market should consolidate around it like we did around 23,500 earlier this month. And fundamentally, at 21,800, we will be sub 22 times PE on the current earnings. I'm not even talking about 1 year forward earnings. So, so fundamentals are moving in the right direction. Everything is fine, but the texture of the market continues to be bad. If if you are an investor, from whatever I could make out, I spoke to some 20, 30 odd investors and experts in the market. Large cap people are buying, but they are buying it in a phased out manner, not putting a major part of the money at the current level. Rather, they are saying that while they don't see a much downside, but they don't see upside till the texture improves. As a result, they will start investing heavily only when the texture improves. Which believes me to the fact that whenever the texture improves, the large cap will see a 15-20% upside immediately. So whether we want to fine tune that or whether we want to do phased out manner depends on the risk appetite of each individual. But fundamentally, there is enough value we see in the markets for us not to be worried from a 6 months, 1 year perspective. Forget about even longer term. But in the short term, the data purely says that the texture is not good. Other than that, towards the end of the week, we saw an interesting video of award awards between Zelensky and Trump. That was expected to be a smooth meeting, but it became otherwise. So much so that there are not Putin talking about interfering. So that kind of a troll is going on. I really don't know what impact will that have, but I think it may slightly have a positive impact because your Russia-Ukraine war may see an end if US decides to withdraw the support. Or Zelensky may even want to get on a dialogue table with Russia if he knows that the US is not going to support him. So that's the only positive I see out of it. But yes, it doesn't look good if I have to talk about Trump politics here. Barring that, there were a couple of interesting news in the portfolio stocks. The airline data continues to be good. We saw RBI coming out with some liquidity support other than the OMA to banks by allowing a lower weightage, by removing the higher weightage rather for the NBFC lending, which means there's a capital free up in the balance sheets of the bank and they can use it to a better use, improving their ROA and ROE by a minute level, but yes, directionally helps them. Also interesting was the announcement by Ultratech to enter the wire and cable business, and that created a havoc at Havells, Polypex, and others because everybody remember what happened to the great Asian paints when Grasim decided to enter the space. So another disruption in another fragmented industry, and I'm sure we will see the planning and the talk by all the managements around it who are impacted. While the process is still a couple of years away, the IRRs for stocks where disruption has happened in the past in any organized industry has been much lower than Nifty, which means investors will not want to touch the Havels and the Polypex of the world even after their correction. We saw what happened to Bharti when Geo disrupted. We know what happened to Asian Paints merger when Grasim did it, and now there is another example. So fundamentally, wires and cable business will not see idly earning growth at there will and they will see a churn in the investors there. Nothing much to add fundamentally. The texture, as I repeat again, remains muted at this point of time. 2100 is an important level from based on my technical team, and the way the market fell on Friday, it doesn't give confidence going into the weekend. The From a data's perspective, I will look at some action from the FII is for me to change my view on the markets. Else, over to April when the earning season comes. So March could be another volatile and tough month. Sitting here at this point of time, that's what it seems like until something really positive comes out. That's a very crisp yet long view from me on whatever I could read, understand, or in this week's market. As usual, we'll wait for the questions. You can type your questions in the chat box. You can drop me a message, and we can obviously talk offline. With no questions, I'll take your leave. Have a good Sunday. Have a good weekend. See you guys around next week for yet another episode of Beyond Bulls and Bears. Thank you, guys.